If one of your major goals this year was to own your first home, then I have some bad news for you. With headlines like, why takeaways and Uber could now hurt your home loan chances, and New Zealand banks reject home loans over spending on Christmas gifts and pets as title rules hit, then you might want to know what the CCCFA is and what it means for you. Also, at the end of this video, I'll go over how you can calculate this yourself and know what chances you have with these new rules. And lastly, I offer some ideas that you can action straight away that will help you get closer to your first home from someone who was once a first home buyer. What is up everybody, Gifford here, and today's video is all about why it's even harder to buy a house than it was 20 years ago. And this is due to tighter lending, which means it's almost impossible to get a bank loan for your first mortgage. So what has caused this? Changes to the CCCFA and what it stands for, Credit, Contract and Consumer Finance Act 2003. And is now in place with the recent changes. I'm just going to give you a brief summary of the changes, so for those keen to read the Act, the link is below. So according to this website, there are 5 key changes. They were certification, due diligence, disclosure, the main one we talk about today and the reason for a lot of people not getting finance, responsible lending, and lastly, advertising and fees. So what does responsible lending mean? Previously, when you applied for a home loan, explaining in the most basic form, the formula was total household income minus expenses equals money left over. And as long as you had money left over, basically, you got a home loan approved. In reality, those expenses also had set rules, like your expected mortgage repayments should be about less than 32% of your total household income. The reason it had to be less than that amount is because there's other bills you have to pay, including but not limited to rates, house insurance, contents insurance, food, car payments, and other things you might spend your weekly money on. One of the hardest things about buying your first house is the fact that each person's financial situation needs to be assessed, as we all have different lifestyles and levels of income. So if you're confused about the process, I would highly recommend a mortgage broker. This brings me to explain what is responsible lending. So remember how I said your mortgage repayments had to be less than 35% of your household income? With the new rules, it now makes it around 16%. But the cruel twist is, by making it half, has actually made it twice as hard, which brings us to what is called DTI, or debt to income ratio. Having a look at a real example from research I've done, lending has been set to about 5 to 6 DTI. So if we use 6, this means for every 1 ratio of income, we can only have 6 times debt to make sure we can cover the mortgage payments in the case the economy goes into tougher times. And spoiler alert, that's what's happening right now with rising interest rates. Previously, before, lenders would allow you to have greater debt. Going back to our example, if your total household income was $50,000 a year, you could get a mortgage of $300,000. If your total household income was $100,000 a year, then you could get lending for $600,000. Now, where this becomes a huge problem is the fact that the average New Zealand house price is now $1 million. Yes, you read that right. $1 million. This means you need to have your total household income just less than $170,000 a year to afford this $1 million mortgage, for example. And just to show you what that looks like, this March 2021 chart says you would need to be in the top band of New Zealand earners to afford this mortgage. So yeah, that's pretty depressing for the lower earners. So very quickly, how the heck did we get here? Let me explain to you as quick as possible. At the start of 2020 was a pandemic that would go to this very day. In response to the economic hardship to come, central banks and local government decided to give monetary handouts as people were forced to stop working and go into lockdown. Along with this came the biggest catalyst of all, lowering home loan interest rates. The rates got so low that there was even talk of negative interest rates, where you would have to pay the bank to hold your own money. However, months after the first lockdown had occurred, the opposite happened. People started to buy up houses, causing the property market to skyrocket. You see, while the average person was trying to figure out how they're going to get by over the next year, they were taking advantage of the lowest interest rates New Zealand had ever seen. As the house prices went up, the frenzy of buying was joined by first home buyers who decided to buy if they could afford to due to FOMO, the fear of missing out, adding to the frenzy. You add to this Tina, which means there is no alternative. There was really nowhere else for investors to put their money. The lockdowns meant overseas travel was a no-go, with borders being shut and airlines grounded. No fancy outings with friends, as everyone was at home isolating. Rising house prices was a global problem. This brings us to now, and what can potential first home buyers do today? Affording a house is totally dependent on your total household income. While it's the same formula, it's just a lot harder now, and the banks want you to have more leftover money each week. So here are my 3 ideas that will help. Number 1, the biggest thing you can do if buying a house in this market is lowering your expectations. You can choose to buy a more affordable home because you're now getting less house for your money. The second thing is budget well to conform to the new rules. Lowering your weekly expenses will therefore leave you with more money each week. Mastering your budget will let you know how prepared you are for home ownership and what it really takes to afford a mortgage. The third idea is raising your personal income, either by asking for a raise at your current job, let them know you're wanting to buy a house as a reason, or by leaving and going to a new job for more income. You can also follow the path that I took, which is if you can't move your jobs for whatever reason, to then go and get a part-time job to increase that total household income. The power of a second job means more income obviously, but also because you're already working that year, there's no additional expenses. However, be ready to be really tired and be pretty burnt out most of the time, but this is what it takes. There is good news in the horizon with slowing housing market as shown by these headlines due to these tighter borrowing rules. And if you're willing to wait, my personal recommendation, there is a thing called property cycles. In these cycles, there is a slump in the market and prices stabilize for years. While no one can predict when that is, if you study the market and prices, you can get pretty close to timing around this cycle. If this sounds familiar, where it is, much like the stock market with its bull and bear markets. I know that buying your first home can seem like a dream, and the best thing to do is not to give up if a house is something you want in life. You will, however, need to be realistic and maybe start off at the bottom of the property ladder going for a house that's not as good in the neighborhood just to get your foot in the door. A secret with buying a house is that eventually the value or equity of the property increases, and since you're paying a mortgage instead of rent, your housing expenses becomes lower each week. Take it from me, I still live in my first house because I'm committed to paying my mortgage off. Lowering my weekly mortgage then means I can invest more money to eventually make me a millionaire. Well, that is it for today's video. Thank you so much for watching. On my channel, I talk about personal finance, property investing, and my stock market journey. So if you're interested in all that, hit the subscribe button. If you want to hear more from me, go over to Instagram and follow me there as I do weekly stock market investing posts and share my trades. Check out my referrals down below if you want to start investing, and this video right here shows you how you can start investing with as little as $20 to get you over $500,000. Otherwise, I'll see you on the next video, and goodbye.